Hi, welcome to this presentation on technical indicators. This video is brought to you by Alpari. The technical indicators are a huge benefit for traders, particularly if you have a nice charting package like you do with MT4 or MetaTrader 4. However, there is a hidden danger here that you need to be aware of. I call it ornamentation or indicator piling, or you'll hear traders talk about analysis paralysis, where you've just got too much stuff piled on your charts, and typically that stuff are indicators. So they can be really useful if you keep it simple, or somewhat problematic if you get too complicated. But let's take a look at, well, what are technical indicators? And they fall into basically one of two categories, or most of them do anyway. The first category are trending indicators. Now, trending indicators include things like moving averages. Now, moving averages are extremely useful because essentially what you're looking at is an average of typically the close price over the last n period of days or hours or whatever charting period you're using. So, for example, if you were looking at a 30-day moving average, what you're going to be plotting on your chart is a moving point that looks at the last 30 close prices and then plots the average price. What that does is it eliminates a lot of the noise that's inherently in your charts and gives you a much simpler view of what's going on. Now, a real common way to look at moving averages, by the way, is to apply two of them to identify not just trading opportunities, but periods in which I might be a little bit more aware of my risk than at other times. So, for example, here's how such a thing would exist. On your charts, you'd apply two different moving averages with two different time frames. One's a short-term time frame, another one is a long-term time frame. Here's a typical example. Let's say we have a moving average that's moving like this, and this is our 20-period moving average. So we've got a 20-period moving average, 20-day moving average here, and we're going to apply a 50-period moving average as well. So we've got a 50-period moving average. Now, obviously, that one is not going to be moving as fast. It's going to be kind of trailing the slower moving average. So we've got these two, and you'll notice that there's a couple of instances where the two cross like this, because the shorter period moving average is using less data. So it's going to be a lot more volatile than the longer period moving average. And what traders will look at is they'll look at this and they'll say, well, I have an uptrend. And what I'm using this little crossover system to do is to identify for me those periods at which my positions are at risk, my long positions are at risk, which would be identified by this short period moving average crossing below the long period moving average. And we've got buying opportunities when just the reverse happens, when the short one crosses above the longer term moving average. So really easy way to identify essentially, or to try to provide a little bit of a definition to the trend. So you have an answer to the question of, well, am I in an uptrend or am I in a downtrend? And how solid is that trend? Am I in one of these situations where I might be a little bit more risk averse? Or am I in one of these situations where I've got the short-term moving average above the long-term moving average, everything's looking nice and bullish, these are good buying periods, this is a period I might try to start watching my risk. Now, I mentioned that there are two kinds of technical indicators. We looked at one with moving averages, and here's a chart, by the way, of I think a good example on the Euro USD. This is a daily chart of two period moving averages. So, and in this case, I did apply a 20 and a 50. And you'll notice that they're crisscrossing each other. They're identifying those periods of time when you may be trading counter to the trend, or when the trend is becoming a little bit more delicate, if you will. So your risk is going up a bit. Now, we can take a step back here and say, well, what about the other kind of technical indicator? In a very real way, they're similar to trending indicators. We call them oscillators. Now, oscillators are, there's a whole batch of them. They all kind of work the same way. And what they do is, rather than identifying the trend, they help us to understand how solid or secure is this trend. Now, an oscillator typically will exist at the bottom or up at the top of a chart, and usually you you can choose where you want it to display. Now, in some shape or another, most oscillators will have a upper and lower no man's land, if you will. In other words, they'll have a point up here above a certain level. And if we take, it's very common to see oscillators moving from 0 to 100. And what they're looking at is they're looking at price movement over time. And these things will move up into overbought territory. That would be oftentimes a really popular oscillator, by the way, that looks like this is RSI. And if it gets up above about the 80 mark, it's in one of these no man lands. It's overbought. And that means that, number one, the bullish trend looks really solid, but we don't want to take undue risk. We might want to make sure that we're covering our positions adequately. Now, the same thing is true when it gets down here into below the 20 mark. So it's between 20 and 0. Things are a little bit oversold. Now, that does mean that that bearish trend is probably in play and definitely strong, but because it's a little bit oversold, we're looking to make sure that we're not taking undue risk and that we're covering our positions. Similarly, when we get a breakout up above one of these levels or below one of these levels, we like to use that as a buying or selling opportunity when it's in line with the trend. Here's an example, by the way. So we've got the dollar yen, and you can see I've applied an RSI to it, and I've identified a couple of times when we get a breakout down from that overbought territory in line with the previous trend, which was bearish on the dollar yen. That's a nice selling opportunity. Similarly, if we can see an opportunity where the trend was up on the dollar yen itself, and we get a breakout up above that oversold territory. So we've got a nice buying opportunity. This is probably two of the simplest ways to apply technical indicators and to get started in at least paper trading some of the ideas around technical indicators. A couple of tips I always give people, besides not using too many, is to get really familiar with a couple that you feel comfortable with and that you like. Your own personal preference is really going to make the biggest difference in your trading and how effectively you're able to use a technical indicator. Keep it simple, stay with the things you like and that you understand, and make sure that you're using them fairly consistently.
This video has been brought to you by Alpari.